I definitely wanted to talk about VWAP because your alternate name is Mr. VWAP as far as I'm concerned, because you've really pushed this into the retail trader sort of zeitgeist. I feel like you have been really showing the importance of the anchored VWAP. I know VWAP has been around for a while, and institutions certainly like to use it. And this is the volume weighted average price. How do you so anchored VWAP is where you can actually choose the point on the chart that you want to start your VWAP calculation. What makes sense to you in terms of traders that have been kind of playing around with this? All the charting platforms are rolling it out. So where do you tend to put those starting anchor points for the anchored VWAP?
Right. So, swing high and low. So, for instance, again, if the move began at 20 and it ran to 30, I'll put I'll put one at that 20 level if that was the low. It's 1997, and it ran from there. And you'll see that pullback to 26 and a quarter often might be the exact low. I mean, it's crazy how the institutions use these things for more than a daily time frame. And then, of course, from the peak, as it begins its pullback, I'll anchor volume weighted average price off the peak. And if that VWAP is still declining and hasn't even had a chance to flatten out, I basically won't trust it yet. I want to see that equilibrium kind of met. That now they're in what I call they pinch together. The volume weighted average price from low comes up, the one from the top comes down, and we get that range compression where the VWAPs pinch together. And when it breaks out above it, it tells me pretty definitively. It tells me definitively without argument. There's no subjectivity to it. It tells me the average price from that peak, the average buyer is now in a winning position. The average short seller also we always have to think about, because people short it. It goes from 20 to 30. Like, I'm going to short this thing down. Well, the average short seller is now losing money if they, have been, basically dollar cost averaging, into their position, working into it. So the shorts are losing money. The buyers have that confidence on the short-term time frame. It matches the picture on the daily time frame, the bigger time frame. So that, those are important pieces. I always have the daily VWAP, of course. I'll use the 2-day volume weighted average price for entries. Sometimes I've got a strategy around that. The week to date, if you look at, so today is, what is it, August 25th. If you look at the S&P and the NASDAQ this week, they've come down each day. Today's Wednesday. They came down Monday and Tuesday, and then again today, and tested that week to date volume weighted average price and didn't go a penny below it. I mean, it's pretty crazy. I look at the month to date, the year to date, from an IPO is really important. So, all time highs, all time lows. And you don't have to use all of those at once, obviously. It's about
Sure.
saying what are the most important pieces, and how do these pieces of the puzzle fit together to show me the most objective picture of supply and demand, so I can be involved at the lowest risk, highest probability time to get involved. So, as you said, I focus a lot on the entries, because if I can get my entry right, where I have a tight stop and I'm getting at the beginning of that new wave of momentum, I'm not waiting for volume, because volume often peaks at turning points and expands in the direction of the trend. So if I'm getting involved right there, and let's say my risk unit is $1,000, if my risk is 20 cents away, well, how many shares can I buy? I can buy 5,000 shares, right? But if my stop is $1 away, I can only buy 1,000 shares. If my stop is $2 away, I can only buy 500 shares. So I want to get as many shares as possible and keep that stop tight. And sometimes I'll stagger my stops a little bit as well, where if I'm oversized in a piece, it starts pulling back a little bit. I'm like, no, not yet. Sell a couple units, and then I might end up buying them back. But there's, because I sit in front of the machine each day, and I actively trade and I work around a position. I don't just put it on and let it go to my price target. I don't really do price targets. I like to say, the price target for a long is higher. My job is to manage risk. I have an indication that, if I bought it at 27.20 and the prior peak was 30 and the primary trend is really higher, well, it should at least go test that. So that just
Mm,
gives me an indication. It's a level of interest. It says it has the potential to get there. Let's see how it responds to a breakout there. Because I own it at 27 and a quarter, I probably will sell some to the people who are chasing that breakout because I own it, 10% lower. So it's all about, trying to work those time frames together. Again, it truly does come down to, to trends and multiple time frames, and supply and demand, and being as objective as possible, keeping the risk tight, and managing risk on the way up as well. Winners don't take care of themselves. You
mm.
have to manage those winners as well, and know where to raise your stops and where to sell partials. And that's the art of trading versus the science of looking at charts and technical analysis.
Hey, it's Evan here. I hope you enjoyed this clip from our full-length interview. Don't forget, if you want to hear this entire episode with even more insights from our awesome guest, you can find it by searching the Smarter Trading Podcast in iTunes or on your favorite podcast app. You can also find all of the show notes for this episode by heading to thetraderisk.com/podcast. Thanks for tuning in.